Well, let's kickstart the Money Show then by introducing our first panel of guests for today. I have with me Bala, Chief Market Technician of CatchTheChaos.com. He's an astute trader who's been around for the most part of the last 2 decades and has, of course, his eye on Dalal Street all the time. And also Anant Ladha, founder of Invest Aaj For Kal, who also runs a YouTube channel with tremendous amount of popularity with the same name. So gentlemen, thank you so much for joining us today on ET Now and on the Money Show, which I'm sure for what is going to be a very, very interesting discussion. So Anant, let me start off with you first. You know, a lot of young people have been lured by the prospects of making that quick buck on the Dalal Street, and why not, right? I mean, in this last 1 year, people who've been buying shares or buying the Nifty or conducting any trading action on the buy side have really made money. But is trading the right way, according to you, to start off your journey in equity markets?
Hi, Mubina. See, I personally believe that there is no good way or bad way. Everything works in the equity share market perfectly, but we need to understand that what works best for us. If you have a time-tested process, you follow it with discipline, and you take take stop loss as your insurance, then it is absolutely okay to start with trading. But always understand yourself first. Before doing your KYC, first do your KYS, know yourself. Also, if you are a fresher, I would strongly recommend to have a portfolio of mutual funds so that your long-term goals can be properly mapped with and can be properly taken care of. So that even if you do some mistakes in trading, your long-term goal is properly taken care of. And on this point, I just want to give a piece of warning. Last 1 year market has been very kind. So if you have generated even superb returns like 100% returns, don't overestimate yourself. Don't think that this 100% is because of your skill. It is purely because of market. If you started your trading in last 6 months or 1 year, your timing was perfect for trading and you must have generated superb returns, which means that you are lucky. Don't confuse luck with skill and have a proper time-based process which you will follow.
Yeah, that's a very important point, not to confuse luck with skill. The return in the last 1 year has also been because of the markets and not, because of your own, trader skill. Not necessarily, rather, let me add that. It could also be beginner's luck. You can term it whatever, but you need to hone on those skills. Well, here's somebody who's already done that, been there and done that. In fact, Bala. Hi, Jay. Let's start off with your own journey, because I know for a fact that you had a job going on and then you decided to get into trading. What were your early days like? Tell us about your initial experience.
Thanks for having me on the show, Mubina. See, I started sometime when I was about 16. I was helping my father, with his trading. Those days it was physical shares, so I need to, take transfer certificates to the broker, and I started around that time. So I've seen Harshad Mehta's boom and bust, Ketan Parekh's boom and bust, Asian financial crisis, Nick Leeson, .com. Global financial crisis. So I've been through the last 2 decades, and I've seen many boom and bust. The bull market brings with it an air of invincibility. So that's something you should, as the gentleman previously said, it's not to be confused with your skills. It's there's an element of luck there, but what you need to do, you should be grounded during the bull market. The bear market will level you to ground, and it's that point you should be prepared for. Those days markets were from somewhere between T+7, if I recall correct, to it's come to T+2. And if you had a good broker in those days, they used to give you settlement in a fortnight. Now you have settlement on a T+2 basis. So markets have gone from open outcry to screen-based trading. So it's gonna see change, and but the underlying principles haven't changed. You got to be disciplined. You got to be focused. You got to have a very sharp methodology, and you should keep your losses from going out of hand. That's the key thing. That's my experience from the market. And I started off when I was having a full-time job, and it's very important to have plan B if your trading doesn't succeed. It's very important to have at least 8 to 12 months of savings kept separately and untouched. You must treat trading as a business. That's the way to go about it.
All right, discipline, focus, have a plan, and of course keep adequate savings. This is the mantra that Jay Bala as well started off with. By the way, Jay, you mentioned bull market and bear market. Do you think as a trader it's always easier, always more encouraging to trade when you are in a bull market?
Absolutely. Bull market, as I said, the reason why, it brings an air of invincibility is that whatever you touch rarely ever goes wrong. And, people have a tendency to buy and then sell later, which is very natural for people to do. In a bear market, it questions that philosophy. It brings level of sophistication. You should be able to, as a trader, sell first and then buy it back. That's a little bit sophisticated, and it's not easy for everybody to do it. So, a bull market is far easier, and it's very forgiving. You can be indisciplined during a bull market. The markets always bounces back, and it's only in the bear market that you realize you've been indisciplined and you need to correct your methodology.
And I think that's the reason why we saw this run in Dalal Street as well, because we were in this massive bull market. Like Jeff said, anything you touch turns into gold. So I think that's something that has given the encouragement and the confidence as well for a lot of youngsters out there to come in and start, trading. Now, Anant, here's where it gets tricky. Many youngsters already have a full-time job. Trading has now almost become something like a pastime which you can do during even your lunch break or sometimes even during working hours, because all it takes is a few taps on your mobile phone thanks to technology. So they must be wondering, and obviously very bolstered by what they have seen in the last 1 year, that why do they need the job in the first place? When is it the right time to ask yourself firstly that, Anand, that whether you should quit your job to get into full-time trading?
See, whenever bull market is there, or whenever equity share market does well, this question always comes up. What I can do best is I will put 4 points in front of you, and then you will be able to decide whether you should leave your job or you should continue your job and side by side learn market. First point is, the biggest issue in equity share market is the cash flow. When you depend on equity share market for your daily cash flows, you end up losing more. Share market is not like your salary that it will accrue at end of each month. There will be patches of months where you will earn humongous money, versus there can be months where your money which is earned from equity share market won't be enough to even fill petrol in your vehicle, versus there can be months where you will even lose money. So first thing, you have to understand that biggest issue in equity share market is cash flows. Second important point is, equity share market always tests your patience, and it even tests your pocket at the same time, and you never know when that time can come. For example, if you are starting your trading journey from tomorrow and markets start consolidating from tomorrow, and you really can't help it, it is part of the game. That is why you have to always understand that if you have regular cash flows, you will always have that peace of mind. Third important point. See, to become a CA, CFA, it took me around 3 to 5 years. To become a doctor, it takes you more than 5 years. To become a good engineer, it takes you 3 years plus. And you think that you can learn equity share market overnight or maybe in few weeks? That is practically not possible. You will need some patience, some practice, and you will need minimum of 4,000 hours of study in equity share market if you want to make it big. I'm not saying that you cannot learn the process. Process can be learned in 1 day, 2 days, or maybe 1 week. But to apply that process with conviction, and then to have conviction on your conviction, it will require some time, just like you gave time to your professional degree. Trading, which is probably one of the most difficult profession of world, you will need to give some time. And finally, and fourth important point, it is known as gravity-free zone theory. It is a very rude thing about equity share market that equity share market always gives money to a person who don't need it. What I'm trying to say is, equity share market will reward you only when you have a time-tested process and you follow it with patience, which is only possible when you are not dependent on that money and you have that gravity-free zone. That is why, if we consider these 4 points, I always say one thing. Best thing to do in market is to learn market side by side. I know it will take some extra pains. You will have to work some extra hours over the weekend, or maybe during the weekdays as well. Sometimes you have to take out some time and study, but it is part of the game. Be it life or market, it always tests you before giving you something big. And if you want something big in equity share market, my personal view is never touch your regular cash flows or never disturb your regular cash flows. Do market side by side, learn it, and use it as a second income. That will be a better situation for you.
So at least when you're starting off, do it as if it's, firstly, you'll have to burn the midnight lamp for it. You'll have to learn. You need at least 2,000 hours. That's Anand's estimate on learning equity markets. And yeah, even in the beginning, you need to do it as a side hustle, not something that can replace your job. And the irony is that if you will go to the equity markets to provide you your daily bread and butter, it may not necessarily do as you would like it to do. Jay, again, I think it's best to get a live example from you. At what point did you realize that, okay, I can actually make a killing, not just a living, out of equity markets? What was that eureka moment, or was it even a eureka moment at all, or is it something that you slowly and gradually decided on, weaning away from your regular daily paying job and slowly moving to trading?
It was a combination of a few things, Mubina. See, obviously, as I said earlier, the reason why I said bull markets bring an era of invincibility is because I came in when the dot-com boom was happening. I sold huge software, Pentafor, HCL Tech. I know there were so many software companies which I exited at the top. I thought I had figured out the market, and so I was in for a rude shock then. So, but what brought me in was that during that time, Enron scandal and 9/11 happened. That time, I was actually, the job markets were very shaky for most of us out here. So, so given the bull market that was behind me, I didn't know it was behind me at that point of time. I thought I had figured out the market and I got the secret sauce, and that triggered me to get inside the market. And people used to come for advice even when I was working as a software engineer at that point of time. And in fact, even my HR manager came for advice. I thought I was going to be fired, but actually he came for advice about the stock market. So I thought I had figured everything out. But the subsequent two years, that was a great leveler and brought everything to the ground. It was I would say it is a school of ego deflation. So that's what the market does. So while everybody comes with the lure of making a lot of money, the period of correction or the period of bear market allows you to develop a regular methodology that allows you to rethink all your misplaced ideologies, misplaced fundamentals. So that's when you get to realize the market. So the trigger for me is that. So usually every bull market brings in people to become a full-time trader, but they start learning the factor. So for everybody, there's definitely a bull market that brings them to full-time trading.
Okay. So Jay, right now, I think it's a situation that's very similar to what you had seen back then in the dot-com bubble. A lot of people, maybe they've not lost their jobs because luckily the economic situation is not that bad, but we're definitely in a big zoom up in the equity markets right now too. Jay, what I wanted to know is, how did you deal with the income situation? Anant pointed out very well that depending on equity markets for your day-to-day income could be a little tricky. So how did you deal with that initial volatility associated with depending on the markets for your income?
Yeah, that's a very, very important question. See, it's earlier when you just plunge into the market as a full-time trader without caring for a lot of things. But luckily for me, I had someone in my family who had done been in business. So in fact, my wife was in a full-time job. She was the one who was pushing me to take up this as a profession. So actually, so she was saying, her job is a most secure job. As long as the company is present, she won't be fired. So that was a fallback for me. So that gave me a considerable amount of cushion, and I had also set aside call it foresight, call it luck, a certain amount of my savings from the previous job as a SAP consultant. I had set aside about 6 months for living off just that, and I had didn't want anything to come from the stock trading as a regular income to pay the bills and so on and so forth. So luck, it was all a few things that lined up. But the markets are a great leveler. It tells you a lot of things. Then it's just as you go forward, that's when you fine tune your methodology, fine tune your income process. You fine tune what is realistic, and then you start breaking down things into realistic, achievable goals. The market tells you a lot of things. If you have your capital, at a very reasonable level, you are able to, learn from the markets. The market is a great university. It teaches you a lot of things. You have to pay to the markets to learn. Whatever either me or Anant tell, most of the traders are unlikely to learn it. In fact, they have to go to the university markets, the university of the market, and then learn from there. You can probably shorten a few things, the learning process from us, but you definitely have to learn a few things from the market. That's inevitable.
Okay, so Anant, when someone is younger, they do tend to be a little more reckless. They do feel that, okay, they can take a bit more risks. And adding on to that is, of course, the fact that, the last 1 year has been great and, you made a lot of money. They may not have realized that, okay, the market itself, the fact that you're in a bull market has a big, big role to play on that front. So, my question is, when you're younger, anyway, you have the ability to take a little more risk. But what's the extent of risk that young traders in the last street should take, according to you, especially when they're just starting off?
See, firstly, I will put forward one point. Taking some extra risk is absolutely okay, provided you have secured your long-term goals properly. Especially if you're young, you don't have any financial liabilities. It is absolutely okay to take some risk and to try and make it big. But in no way I am saying that taking risk is equivalent to gambling. There's a slight difference between gambling and taking calculated risk. Share market is a place which will treat you the way you treat it. For example, if you want to treat share market as a place for gambling, there is no biggest place to gamble than share market. Versus if you want to take it as a wealth creator and as a business, there is no bigger wealth creator than equity share market. So you have to first understand that there is slight difference between taking extra risk, calculated risk, obviously, provided you have secured your long-term goals, versus gambling. Also, I will say that take the risk, but only that much risk that will allow you to be in the market to take another risk. Also, no risk is worth it if you are having sleepless night. Always sell down to your sleeping levels. And like we discussed last time as well, if you are taking some risk and tomorrow market gap downs by 10% and you are in shock and you are in panic and you are in no man's land, you should not take that risk. But if you can manage that part, then it is absolutely okay to take some extra risk and try and generate some extra returns and to try and make it big. Especially if you are young, it is your golden opportunity to take some risk and make it big in equity share market.
Jay, when you started, everyone's burned their fingers a little bit. Everyone's made those mistakes. They've learned from those mistakes. What were some of the mistakes you think you made in the beginning of your trading career, which almost made you feel that, okay, this is probably not for me? And what did you learn from them?
Yeah, sure. Everybody has had those kind of moments, who's been successful and still in the business of trading. Everybody would have gone through such a moment. The thing is, risk management is something that you learn the hard way. That is something you don't figure out right in the beginning of your trading career. You lose money in the markets. Make sure it's manageable. You go on. That is the biggest mistake I made when I started trading. I didn't have any clue about asset allocation and the level of allocation or the level of risk per trade that I'm taking. I had absolutely no clue about it. And while I didn't go all in many trades, but I realized in hindsight that I was taking risks that was disproportionate to the level of my broking account equity. That's a very important factor. The amount of risk that you take in each trade, that's in fact, I would say closer to the holy grail of trading. I had put my money in all my entire equity in 4 stocks based on a particular takeover code SAST procedures that based on somebody's newsletter. So I had put all my risks in just 4 stocks. That is absolute no. And luckily the capital at the time was quite small, and the lessons that I learned from that, while very hurting, it was a very important lesson to learn. And obviously that made me question: am I even fit for this kind of career? Why did I leave my full-time job and a successful full-time job? You are bound to go through that kind of process. But it's important to keep things small and learn from from your mistakes. And I often tell my people that mistakes have 1,000 cousins, but it doesn't mean you have to commit all the mistakes. Commit a few and learn from them, and just limit yourself to a few, and you can experience the 1,000 cousins from what others make. You as a new trader, it makes a lot of sense for you. In fact, it's very wise to learn from somebody else's mistake rather than you committing. So if you are saying something, look for what are the mistakes we're actually doing. Don't over allocate. Don't go all in one basket. Don't excess allocate. And just because a stock's price is very, very low, that doesn't mean it's your stock. You don't put 50% of it if a stock is priced under 10 rupees. And you don't allocate just a small amount if it's something like a stock like Dr. Reddy, which is priced in several thousands, or MRF for that matter. If it's your asset allocation has to be uniform. This was the biggest learning, and this was the biggest mistake I made, and the markets taught me this.
Yeah, the best mistakes actually are learned from real life experience. For Jer, it was for not keeping your trades small, not excessively going in one particular trade or one particular bet that you believe, even if you have conviction in it. Always leave room a little bit at least. If it does not play out as per you, then you've not lost that much. If it does play out, then even better. Anant, in your first answer, you mentioned that okay, you get into trading, but then keep a little MF portfolio as well. So in the beginning, how would you recommend investors sort of split between how much they're putting into hardcore savings for the future, for wealth creation, etc., and how much can they initially start off with? Would you have a percentage or something, let's say, of someone's income? That would be easier for our viewers as well, the younger ones, to understand.
See, as such, we cannot have a fixed percentage for everyone, but I will first say that first do your suitability test, then properly have your goal planning, do your goal planning and map your complete investments to your goals. Firstly, whatever surplus amount you have, you can start trading with that amount. If you are a youngster who is 30 below and who is right now not having any financial liability on him, you can probably have a 50% split at start, and then eventually see that what suits you best, and you can allocate your more capital towards what is suiting you. So you can start with a 50% mix at start if you are too much fascinated towards trading, and then market will automatically place you properly.
Well, I'm sure it's an inexhaustive list and we could probably go on and on, but I'm afraid we're out of time as well. So Anant and Jay, thank you so much for joining us today on The Money Show in what has been a very enlightening session for all of our viewers. Thank you once again.
Thank you. Thank you for having on the show.
Well, you can catch this entire conversation on ET Now's YouTube channel, but for now, we're going to take a very short break. Be right back.